Foreign exchange markets are reeling from sweeping new US tariffs. 25% for India, 35% for Canada, 39% for Switzerland and 50% for Brazil. The Trump administration is pushing ahead with plans to reshape the global economy through tariffs. Most of them kick in next Friday. Stocks have had a modest reaction so far, but the dollar is on track for its best week in almost 3 years. Francesco Pesole is an FX strategist at ING. Francesco, had currency markets priced in this comeback for high tariffs, or is it a surprise?
Oh no, I believe it was fully priced in. But I think what really matters the most is that markets, at least the FX market, but I think it's a good consideration to be made across broader asset markets. Really, they continue to treat this with quite a lot of skepticism. And the reason for this is that I believe what we've learned from the past 3 months is that Trump tends to be a deal maker. So, in a way, there's always an open path for negotiations. And so, despite the fact that obviously he's surprised with some large tariffs on a number of countries like the ones you mentioned, I believe that markets continue to price in as a baseline scenario that trade deals will be ultimately agreed.
Some currencies have been quite badly hit against the dollar this week, though, haven't they?
Yeah, but that doesn't really have much to do with tariffs. I think what we've seen at the start of this week was a bit of growth reassessment, especially in the Eurozone and relative to the US. There was initially, due to the trade deal between the US and the EU, which markets assessed as being disadvantages for the European Union. But after that, also data confirmed that US growth is more resilient than expected. And then there was also the Fed effect, with Powell sounding quite firm on his view that there will be an inflationary impact from tariffs, and he didn't signal any willingness to really change to a dovish stance. So tariffs for now remain pretty much sidelined in FX, focuses on data and the Fed.
Is the long-term trend against the dollar reversing, though, or is this a temporary move?
We think it's a temporary move. We think at the same time there's probably in the short term a little bit room for on the upside for the dollar, because there's still almost 1 in 2 chances of a rate cut in September priced in when it comes to the Fed. So obviously there will either be priced in entirely in or out in the next month and a half. So we think it will be priced out because we believe inflation will come on the hot side in the US. So in that sense, there is a little bit that short-term rates can do to help the dollar in the short term. But then when we look at the end of the year, we think that as soon as the Fed starts cutting later in the year, the dollar will probably rejoin the sort of downward path that can probably last multiple quarters.
What about the political pressure on the Fed? If markets are currently pricing in a more hawkish short-term Fed, what difference would it make if we see yet more pressure from the Trump administration?
I think at the moment it's being treated similar to tariffs in a way. So Trump is extremely vocal about it, but then when it appeared that Powell would be imminently sort of fired, Trump decided not to fire him. So markets are now running under the assumption that Trump does not want to risk causing the market mayhem that could be the consequence of Powell being fired. I think what markets will be mostly focused on will be the pick for the next governor, who will most likely be the next Fed chair around the end of this year, the beginning of next year. But for now, I think the only effect that we can still see of that political pressure on the Fed is probably the fact that markets are still not convinced to price out entirely that September rate cut, despite the Fed and data having given no indications that that is a possibility.
It's interesting, isn't it, for FX that the US is adopting this aggressive trade approach at the same time as its swelling deficit requires more foreign capital inflows. Will the trade shift eventually drive international capital further away from US assets, do you think?
Yeah, that's a tangible risk, I believe. At the same time, we must consider tariffs also from a public finance angle. One of the reasons why our baseline at ING is that tariffs will remain in place for the whole duration of Trump's term is that very simply, Trump needs the money that comes with tariffs to fund some of the public spending and the rate cuts and the tax cuts. So with that in mind, these things do go together. The protectionism policy and public finances. I think for now, the whole debt sustainability concerns are being put on hold by the market, but they can definitely come back to haunt should sort of growth prospects start to deteriorate again, and should the bond market start to feel more pressure.
That was Francesco Pesole of ING. Don't forget you can watch more videos on Reuters.com.